Okay. So quant investing can be defined in basically three main aspects. Quant investing, also popularly called as rule-based investing or systematic investing, is essentially a very data-intensive process to investing, which leverages on computing power to essentially find opportunities across a broad range of stocks. Uh, this differs from fundamental investing in the sense that a fundamental manager typically looks at a very concentrated set of stocks, but in much more depth. Second is that given the statistical nature of the mathematical and statistical nature of the process, people think it can be black box. While that is not necessarily true. In our case at Axis, especially, it's a completely white box product. By that, what I mean is the inputs, the parameters that go in, the approach, and the portfolio is completely transparent. And the fact that we also use fundamental parameters as major inputs in the model mean that this process is both quantitative and fundamental. Lastly, the portfolio construction process is completely systematic, wherein it minimizes human interference and reduces behavioral biases. The key benefit of quant fund is firstly its ability to harness increasing data and the ability to look at a broad range of stocks, especially in this environment. As you've seen, our markets have evolved over time where the number of listed stocks have increased massively. So that also presents both an opportunity and challenge. For quant, it's more of an opportunity because it can leverage both the data and the fact that the universe is much broader now. So that is a primary benefit. Second is the fact that um, because you can look for opportunities across a wide range of stocks, the product capacity is large enough to accommodate all kinds of investors and accommodate large mandates. Third is the fact that because it's systematic in nature, what you do is you eliminate human biases, you eliminate behavioral biases, and lastly, an advantage that is specific to our markets is that as of today, there are not many quant offerings in the market out there. And quant products in general tend to have very low overlap with other popular products, and they also tend to have low correlation with other products out there. So, what this does is this adds diversity to a client's portfolio of funds. So, those are largely the benefits of having a quant offering as part of your book. While a mathematical formula is central to quantitative process, there is much more to it. The fact that we implement the process systematically is the key behind its success. Now, with regards to the quant process itself, one of the advantages, as I touched on before, is the fact that you can look at a broad range of investment universe to identify opportunities. What this means is that the end portfolio that comes out has very little overlap uh, with existing products, both in terms of the names, and also less correlation in terms of returns. Third is the fact that quant relies on breadth, not on concentration. Whereas a fundamental manager would focus on having a concentrated portfolio, quant relies on having a broad breadth of stocks in the portfolio, which means it has less concentration risk and hence less overall portfolio risk. So all these three are the main advantages why you would want to have a quant fund. But having said that, no fund or no product can outperform across cycles. Every product has its own cycles, has its own cycle. So to that extent, it is not about a fundamental approach versus a quantitative approach, but they both are actually complementary. So a client needs to have both these products in their portfolio because a quant product essentially diversifies away your risk and hence makes your portfolio of funds a lot more robust, and it will help you perform well across all cycles in the market. So as I said, it is not about one versus the other, but actually they both are mutually complementary. The quant investing process has two aspects to it. One is the stock selection and the other is portfolio construction. In stock selection, essentially what you have is a mathematical or statistical model which is composed of inputs ranging from price data, volume data to fundamental data. And based on this model, the entire universe is ranked, or there is a score calculated for each stock in the universe. And typically, the way it works is higher the score, higher is the expected future returns, and vice versa. Now, once you have a stock selection model, you've identified an opportunity set that you want to be associated with. But that is not the end of the story. What you do is the next part, which is portfolio construction, which is it is equally important, if not more. What you do here is you combine your stock selection with the risk of the stock, and along with other portfolio constraints like stock constraints, sector constraints, liquidity constraints, and so on and so forth, to put together a portfolio. And this portfolio is then reviewed and rebalanced on a pre-decided basis, and that is typically how a quant investing framework works. The fund manager's role in quant investing is more from a research and implementation standpoint. While the process itself is systematic, a fund manager plays a key role in constructing the model. And because the model itself will have a lot of parameters, and will have a lot of inputs. So the fund manager role or the researcher's role is to decide which inputs go in, and what is the extent of exposure one takes to those inputs, and so on and so forth. Second is the portfolio manager also decides on the portfolio construction framework, in terms of what is the extent to which one can take stock bets, or the extent to which one can take sector tilts, and so on and so forth. So the portfolio manager plays an important role both in designing the model and in designing the product. And on an ongoing basis, once this is done, obviously the portfolio implementation is systematic, but once this is done, a portfolio manager and the team continues to focus on new research signals and trying to figure out how best to improve the process and improve the model. So that is largely the role of a manager in a totally systematic quantitative process. The key risk associated with quant funds is primarily, first is the ever evolving nature of our markets. The number of stocks, the sector, and the markets are constantly evolving. Investors new set of investors are coming into markets, which means the market behavior is constantly changing. Also, there is always new data available to be to analyze. So the model constantly needs to be evaluated and needs to be improved on, or else there is a risk that the model becomes irrelevant. So that is one of the primary risks associated with a statistical or a mathematical model. One needs to keep looking at it to make sure that it is still relevant in ever-changing markets and these volatile times. Second is the fact that I would argue this is also true for any other approach for that matter, is that you need to have a hold on the risk aspects of the portfolio, wherein you control for the risk, be it at a stock level, security level, or even from a liquidity standpoint. All these things, the risk at a portfolio level needs to be well controlled, and it needs to be managed as per requirements. So I think those are the two main risks associated with quant products that one need to watch out for. I think most quant funds would fit most investors' portfolio. It is no different from a traditional. If you take long only approaches, for instance, it is no different from a traditional fund that's been offered out there. From a risk perspective, from a return perspective, it is very similar. What is different is the fact that the stock selection process is systematic, and the portfolio construction process is completely based on a set of rules, and to that extent it is different. But otherwise, the portfolio from a return risk perspective, or a distribution of returns that it offers from a risk perspective, is very similar to a longer to a non-quant approach. I actually think adding it makes sense because, as I said previously, it offers diversification, and hence and hence basically strengthens a client's portfolio.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.